Okay, folks. Your quizzes are still upstairs in alphabetical order last time I checked. So if you haven't picked them up, please do, because at least you can check to see, make sure the grading is okay. So today we're going to switch gears. And I know the email I sent out yesterday, I said this is going to be, it's almost like a mindset shift from intrinsic value to pricing. Okay. So to kind of set up the process, I'm going to talk a little bit about the start of the class test is going to be focused entirely on pricing. But let's talk a little bit about why so many more people price companies and value them, and why pricing is very different from valuation. You talk to equity research analysts and you ask them whether they do discounted cash flow valuation. Some of them might say they do, but their heart's not in it. They do pricing, P/E ratios, EV to EBITDA multiples, EV to sales. And one of the reasons they say that they don't like to do discounted cash flow valuations is because you have to make a lot of assumptions. Let's stop there. Is that true? Right? You've done, think of everything in your model, right? You've layered assumptions on top of assumptions. So I don't like to do that. That's why I do pricing. Is that true though, that when you use a P/E ratio, EV to EBITDA, EV to invested capital, that you're not making assumptions about cash flows, growth, and risk? Kandar, what do you think?
I think they're making it up.
Right? How much is the P/E ratio for NVIDIA right now? Sky high, like 80. So when you pay 80 times earnings, are you making assumptions about future growth? Yeah, you're assuming growth will be really high. The only difference between you and somebody doing an intrinsic valuation actually put a number. You are just doing it implicitly. I will leave it up to you to decide which is more dangerous. To walk into something knowing you need a high growth rate and knowing what it is, or walk into something knowing that there's going to be a high growth rate and don't even ask a question about how high does that growth rate have to be. One of the things you're going to notice me doing with every multiple, and this is going to sound like a grind, is I'm going to go back to basics, use a discounted cash flow model and actually restate every multiple in terms of intrinsic value measures. In fact, your discounted cash flow model that you sent me can be very quickly converted into an intrinsic multiple model. All you need to do is take your value per share and divide by your earnings next year. You got an intrinsic PE by your book value, intrinsic price to book. So we're going to talk about why this is not true, that you're not making assumptions. You are making assumptions, but they tend to be implicit rather than explicit. Now let's think in terms of mechanics. The other thing I said is there's going to be a mind shift here in terms of shifting away from DCF and intrinsic valuation to statistics. And statistics is all about taking large amounts of data and making sense of that data. And one of the tools we use to make sense of data is distributions. I won't embarrass you by asking you how much you remember about your statistics class, but let's be quite honest. You leave the statistics class in your rearview mirror and ask you, what distributions do you remember from your statistics class? The answer usually is 1, which is the normal distribution. The normal distribution is an amazing distribution. Let's face it, there are so many things in the world that are normally distributed. But the PE ratio might not be. So let me ask you a question. When you take the PE ratios for every company out there, cross-sectional, say 10,000 companies, you put them on a distribution, a histogram, and you draw the distribution. Can PE ratios across companies ever be normally distributed? Lambert, why not?
The minimum is going to be 0, but you can,
Yeah.
by theory, go infinity.
Normal distribution, go from minus infinity to plus infinity. So already you know that the lowest value is 0. You cannot be normally, in fact, all your outliers are going to be big. In fact, in statistics, we call these positively skewed distributions, right tail distributions. In your statistics class, you probably said, who really cares, right? We're going to talk about how that plays out in the numbers we use in investing. I actually think you should never use an average PE as your comparison when you talk about cheap. And it's a statistical reason, nothing to do with the economics of finance. So we'll talk about distributions, not because we care about distribution, but because they're key to doing pricing better. Okay. Yes?
But isn't there a negative P ratio?
I'm sorry?
There's also like negative.
Never. I've never seen a negative. When the earnings are negative, what happens? What do you see reported for your company? You see not meaningful or NA. You'll never see a negative PE ratio reported. So mathematically, say, what if people stop reporting PE? So when you see the average PE ratio for the market, they're basing it only on companies that have PE ratios. Can that create a sampling bias?
Yeah.
Yeah. What kinds of companies are you ignoring? Which are going to be smaller, riskier, money losing, younger. We create bias in all kinds of ways when you do pricing. Might as well be aware of the bias we're creating. Right? Finally, let's suppose I come to you and I say a stock is cheap because its PE ratio is 12. And the median PE, let's replace the average with the median because that's more meaningful. Median PE for the sector is 20. And I tell you the stock is cheap. And I allow you to ask me questions. It could be cheap, but ask me the questions you would use to determine whether the stock is truly cheap. Think in terms of fundamentals. Irma? What growth is it? So let's start with each one. So if you talk about growth, so you ask me, what's your earnings growth? Many of the times when you look at a low PE ratio company, what are you going to see as a growth rate? Low growth, negative growth. So you're going to ask about earnings growth. What else? You ask me about risk. How risky is this company? Maybe it's in the riskiest part of the world. So growth matters, risk matters. Would you also want to ask about the quality of growth? What's a variable that will tell you whether the growth is high quality or low quality? This is earnings per share growth. What is the return on equity, right? Because it's an equity multiple. Most of the time, companies that look cheap deserve to be cheap. So when you see a stock that trades at 12 times earnings, most of the time it's not a cheap company. But the essence of pricing is look for mismatches. The company is a low PE, but a high growth, low risk, and a high return on equity. That's what pricing is. Pricing is about finding mismatches. You're still going back to fundamentals, cash flows, growth, and risk, but you're using it to look at a multiple and say, is this stock cheap or expensive? So what I'd like to do is finish off the last piece of intrinsic value. We were talking about, we're talking about Royal Dutch and I was talking about how the value of Royal Dutch was a function of the oil price. Remember, I came up with the value of $39 per share with oil prices of $45 per share. And I stated the obvious. If oil prices go up, the value will go up. If oil prices go down, the value will go down. But still, in the back of your head, it's kind of, it's creating unease, right? You're saying, it's $39, but the oil price could change. And I talked about running a Monte Carlo simulation. Monte Carlo simulations, all you're doing is you're taking a point estimates for something and replacing them with distributions. The point estimate right now is the current oil price, $45. What if I replaced it with a distribution of oil prices? The Monte Carlo simulation, I'll give you a price, but I'll also give you the distribution. Where did I get the distribution? By looking at actual price changes in oil over the past 25 years. You're saying, what do I do with this? Here's how the simulation works. It goes in and picks an oil price out of the distribution. Could come up with 53, higher than the current stock price. It converts that oil price into revenues. You're saying, how the heck is the computer going to know how to do it? Computers are dumb. You got to tell them what to do. If you remember the graph that I drew that linked up revenues at Royal Dutch to the oil price, I actually not only got a nice looking graph of how the two were linked up, I actually ran a regression of revenues at Royal Dutch against the average oil price. And what I got as a coefficient is every $1 increase in the oil price increases my revenues by 4.039 billion. So if you gave me a $53 oil price, I'm going to plug it in, come up with expected revenues. I calculate the revenues, and I use those revenues to calculate a value, which will be higher than 39 for obvious reasons. And I drew this over and over and over again. Crystal Ball's default is 10,000 simulations. You can change it to 100,000, a million. It's overkill. Once you get past 50 or 80,000, there's really no point. But it's actually magical. As it runs the simulation, the distribution will start to form on the graph on your computer as you see it. But when it's done, here's what I got as my distribution of values for Royal Dutch. So instead of giving you one value for Royal Dutch of $39, I give you a distribution. You're saying, what am I going to do with this? What do we do with value? Make decisions on whether to buy or sell, right? The stock at the time that I did this was $41 per share. With the distribution, I can tell you what the median value is. It's about $37, which kind of confirms what I got with my base case, which shouldn't be surprising. But in addition to that, if you ask me at a $41 stock price, could the stock be undervalued? I can now answer the question. Yes, it could, and I could give you a percentage. There's a 38% chance it's undervalued. Think of as a decision maker how much richer this process is. They're just giving you a point estimate of value. I give you a distribution. Isaac?
But there's also like a 68 chance it's overvalued.
Exactly, right? So in a sense, you're going to factor that in. And here's how it will play out. Let's suppose you have 100 stocks, and I give you in addition to the amount they're undervalued, the percentage of the time they're overvalued and undervalued. It could enter your decision process. It allows you to make better decisions because instead of giving you one number, I'm giving you a distribution. The nice thing about Crystal Ball is you can take your DCF model that you sent me, add Crystal Ball to your front because you have it access free, and you can almost instantaneously convert your point estimate DCF model where you gave me a value per share into a distribution. There are two barriers to doing it. One is that to do this, you need to remember statistics beyond just a normal distribution. In other words, if you just take Crystal Ball, put it on, and make everything into a normal distribution and estimate the parameters, it'll be garbage in, garbage out. Because life is not normally distributed. Interest rates, inflation. So as you think through this, you got to go beyond the normal distribution. Second, once you pick the distribution, you got to come up with parameters for that distribution, right? What's the standard deviation? So I don't want to delve into the depths of it, but to cover the first aspect, if you go to my website, I have a 12-page write-up on different distributions. So basically right skewed, left skewed, when would you use it? Kind of a very quick review of when you open up Crystal Ball, it gives you 53 different distributions you can pick from. And you can look at them, what the heck is that distribution? Never heard of that one, never heard of that one. Now, this will give you a background as to picking the right distribution. And second, it'll give you some suggestions on how to get, and we're in a better position now to fill in those distributions because getting data can either come from looking cross-sectional. Right? I'll give you an example. Many of you had to pick a target margin for your company, right? And you picked a number. It might have been an industry average. What if you could make that a distribution? Because that industry has 55 companies, there's going to be a distribution of margins. Put that distribution in, it'll allow your intrinsic valuation now to reflect the uncertainty you face. The way I describe this is we're all, as human beings, afraid of uncertainty. So when you finish your evaluation, I feel so uncertain. That will never go away. Well, all you can do is be upfront about that uncertainty. That's what Monte Carlo simulations do. It allows you to quantify your uncertainty. This is how it plays out in value. Any questions? Yes.
So in space prediction, there's like a 37% chance other companies will come out based on distribution. So expand on that.
Well, basically, you look at where the stock price is, because as part of the output from the Monte Carlo simulation, you get the distribution of values. Stock price is 41, it's going to put me right there. So you can actually see where it falls in the distribution based on what you got from the simulations. If the stock is trading at 75, guess what? It's at the 95th percentile. When I valued NVIDIA last summer, I actually did this distribution of value. The distribution of value told me it was possible that NVIDIA was worth $800 per share, but there's only 12% chance of it happening. So by having the entire distribution of values, you go beyond just saying cheap or expensive. You can give me some estimates, which is really more honest than saying, I feel that this company is cheap and I know it, because we never know that. This allows you to kind of quantify your uncertainty. It's also a way in which you can kind of incorporate that margin of safety that's this big value investing concept. It's embedded in there, right? I don't need a margin of safety. It's in there. You can make your decision and say, look, I will buy stocks only if they fall below the 40th percentile. There's a 60% chance of being undervalued. And you can add that as a constraint into when you will invest in a company. Yes?
You know, like NVIDIA, this thing like AI is going to be a huge.
That's basically it. The more uncertainty there is, the longer the tail is going to be, right? So the way in NVIDIA it played out is the size of the AI market I got by looking at 3 different estimates of how big it's going to be. Right now, those numbers are all around 350 billion, but they were outliers. It said it could be $1 trillion, right? It's an outlier right now. It'll go to your distribution, but that outlier can mean that there will be some scenarios where the value actually is $800. Exactly, exactly. And but the probabilities will take care of that, right? It'll be a 3% chance it's undervalued or 8% chance it's undervalued. Are you comfortable investing in a company with that percentage going for you? Yes, Dor.
Oil prices, right?
The oil prices, the oil prices get plucked out by the distribution, right? So in a sense, I don't even see it happening. I plug in the distribution of oil prices, the simulation plucks from that. No, in your original valuation, you had input numbers, right? So think of an Excel spreadsheet. I ask you for revenue growth, you enter a number. Once you install Crystal Ball, you get to that cell, you can enter a distribution. Each input that you want to make. So basically, it looks just like your Excel spreadsheet, but with Crystal Ball, what used to be a number now becomes a distribution. That's why it's almost magical, because it'll take a traditional Excel spreadsheet, which you've already worked on, and convert it to a simulation with absolutely no work involved in terms of, bringing in additional cells.
Was that crystal ball as well?
Crystal Ball, yeah.
Okay, so this is random outputs.
These are not random. Random
This is not historic, right?
What's not historic? So tell me what you're pointing at. Are you
Okay,
pointing at the output or you're pointing?
histogram, the blue one.
That's output
Okay, that's an output of a simulation.
coming from the input distribution. There are 2 things I put distributions on. So as each simulation from those distributions, I get input values that are sucked out of the distribution. They're not random because they come from the distribution I give it, right?
Okay.
So each time I run a simulation, it picks an oil price, it picks a margin, it values my company. Then it
Okay,
doesn't.
so, and I guess the variables here are historical margins and historical prices.
Doesn't have to be, right? It could be historical, it could be cross-sectional, it could be a forecasted value. In the case of NVIDIA, my big uncertainty was about the total market for AI chips. The distribution is around that number. I can use historical data, but with the AI market, that's not going to help me.
Exactly.
I can look at people's forecasts for the AI market, which often might be, so I might look at 7 different estimates. Remember the point estimate where you had to pick one of the 7?
Yeah.
This one, you can let all 7 play out as a distribution, and each time Monte Carlo simulation is run, it'll pick across those.
And
So,
then all that is run and the output gets aggregated
exactly,
into this,
exactly.
just to understand, how the variables relate to each other.
It makes real what we hide from in point estimates, right? And here's what I mean by that. When I asked you for a revenue growth number, you came up with a number, right? But in the back of it, you said, but I could be wrong on this.
Right.
Here, I'm asking you, tell me how wrong you could be. So essentially what it does is it tests you on the input side. This is your base case input, but tell me how uncertain you feel about it. Because when you think about your intrinsic valuation, you felt, let's say you felt pretty solid about the revenue growth number. The distribution is tight on that one, but the margin could be any number because you can
Or
then,
sales to capital ratio.
exactly, whatever the number you feel most uncertain about, I push you on that uncertainty. I make you quantify that uncertainty to a distribution. And that's healthy because it means you can't hide behind, I'm uncertain. I'm saying, okay, I understand you're uncertain. Tell me how the uncertainty will play out, as not just as high and low values, but in terms of the distribution across those values. Yes. Yeah.
When you,
No, go ahead and then I'll come back.
when you input two things, right? Say you have two distributions with the same valuation, you get all these outputs. Is that accounting for all different combinations?
Exactly. And in fact, in Crystal Ball, you can even put correlations across the inputs. And let me explain why. Let's suppose you believe the periods where revenue growth is higher than expected, your margins are also going to be higher than expected. You put in a correlation, so it's, you could do this by hand, be incredibly, incredibly tedious. You could do it with the mainframe 40 years ago. It could cost you millions of dollars. Today, you can convert any Excel spreadsheet into a simulation, but it does mean you will spend more time kind of probing how uncertain you are and quantifying that uncertainty. Yes.
So, at the time this was done, the stock was at 41. Does that mean that 36.99 is what the value of the stock should be?
That's right. The median, if you still force me to a point estimate, my point estimate would be 37. So it's instead of doing the base case valuation, where this is essentially will become the single number if you ask for a single number. But as a decision maker, you might ask for the single number, the 25th percentile, the 75th percentile. So in other words, you can, and then as a decision maker, you can then bring into the decision process, not just that base value, but the distribution of values. I mean, think of two companies, both undervalued by 10%, but one has a very tight distribution, but there's only a 1% chance of it being overvalued, and the other is a very wide distribution. You might say, I'll go with the very tight distribution because I feel more comfortable about it being truly undervalued. Yeah. Any other questions? So now let's start by starting the mind shifting. In intrinsic valuation, the value of a company, a value of a business, a value of an asset is a function of its cash flows, its growth, its risk. Discounted cash flow valuation was the mechanism we get there. And we hold our noses sometimes to make the estimates because we're uncertain, but we estimate value. But there's another way in which you can put numbers on assets, and that's by looking at what other people are paying for similar assets. So this is where the first mind shift happens. Now I'm not asking you what you think about the company. I'm asking you what you think other people think about the company. It's like you're playing mind games now, right? You're looking. It's the old Keynesian statement about beauty contest, right? So as people come onto the stage, you're not looking at the people coming onto the stage. Yeah. Or in the social media age, you're not looking at the actual earnings announcement. You're looking at what the tweets are about that earnings announcement to see if people are excited about this number, disappointed. And let's face it, this is the way we live our lives now, right? We've turned our choices over to crowd wisdom. I mean, I might have given this example before. You decide which restaurant to go to, you look up Yelp reviews. I mean, who looks up the New York Times review of a restaurant anymore? You turn on Netflix, you have no idea what to watch. You leave Netflix, you go to Rotten Tomatoes, you see, hey, 92% for, whatever it is. I'm going to watch that because everybody else likes it. Could that be dangerous? It's crowd wisdom, if you want to think of. So the way in which Silicon Valley would describe it is this is crowd wisdom. And the reason I am a little skeptical about trusting crowd wisdom all the way through is the place where we had crowd determine choices the most is financial markets. We've had it for hundreds of years. Crowds set market prices at the end. And what have we learned from financial markets? That crowds can not just be wrong, but they can be systematically wrong. one of my favorite books is a couple of 100 years old. It's called The Madness of Crowds. It's a great book. It's about how the South Sea bubble, basically how it's about the opposite of crowd wisdom, which is crowds can sometimes be lemmings run right off a cliff. So when you do pricing, you accept that as part of the process. And you're okay with it. Because in return for accepting it, you get a lot of easy stuff happening where you don't have to delve into the depths of a company because you trust the crowd to have done it right. So in pricing, you're looking at what will other people pay, and the tools you need to bring in for pricing are very different than the tools you use for discounted cash flow valuation. Because if your interest is in what do crowds think, everything you do will be trying to determine crowd mood, crowd momentum. I know we give short shrift to technical analysis. You know, any finance class, you say, oh, people look at charts, those people are so unsophisticated. What's the base of what are you trying to do when you look at a head and shoulder or look at all these charts? What are you trying to do in a chart or technical analysis? Yes, go ahead.
I think with technical analysis, it's just like the patterns they observe in the past. They have the assumption the pattern will repeat.
Yeah. And in fact, if you think about it, if you see in head and shoulders, where basically they do a chart, it broke down a resistance line, it goes through a support line. What they're looking for is shifts in mood and momentum. That's basically what, if you break charting down, that's basically what you're trying to do.
I mean, they're looking at volume. They're looking at.
Which could be
volume
an
of orders.
indicator as well. And again, why are you looking at volume? Because if high volume goes with a big price change, it's viewed as very
Volume
differently.
buys and
Because
sells.
again, if you cut it, and many charters don't realize it. If you look at what charting and technical analysis, it's about detecting shifts in mood and momentum before they actually happen. Because if you can do that, you can be an incredibly successful pricer, or as I prefer to call it, a trader.
Day trade.
The essence of it doesn't have to be just day trading. A lot of people who claim to be investors are really traders, right? They hide behind, I do a DCF, but in fact, they're looking at things that give you tools for detecting shifts in mood and momentum. Already you can see if you're doing pricing, your toolbox is different. It's not discounted cash flow valuation, cost of capital. It's about pricing tools and helping you detect shifts in mood and momentum before they happen. So let's talk about value versus price. So intrinsic valuation delivers a value. This demand and supply delivers a price. There's one world where the two will converge. That was the world finance lived in for the 1960s. You know what that word is, right? What world will value and price, be in an efficient market? The gap is not there. Or if it's there, it's completely random. You can't find it. So if you truly believe in efficient markets, what should you do? Buy an index fund. There's no point doing intrinsic valuation, but value and price converge in the efficient market world. When Gene Farmer won the Nobel Prize for the efficient market work he did, actually it was twinned with Robert Shiller, so it's kind of funny, two people at opposite ends of the spectrum on efficient markets. Gene Farmer talks about value and price is interchangeable. He's on perfectly firm ground because he believes markets are efficient. If you don't think markets are efficient, then you get two variants. The first shows up in Omaha, Nebraska every year for the Berkshire Hathaway conference. I call these the value extremists. What do? They believe that value is the only thing that matters. Markets are shallow, their price can go all over, but price will always converge on value. So if you believe that, then you view pricers and traders as people who have no idea what they're doing. Markets is completely irrational. Anytime people use the word bubble and irrational, they're giving away what they think about the rest of the world. I'm smart, they're not. I think deep, you don't. And this is why the minute you throw those words on the table, there is no discussion to be had because you're saying value is right, price is wrong. The price will always move to value. And there's a third view. Well, of all the CNBC shows I am on, the one that I enjoy the most is the one after the close of the market, where you have the four people on the show are people who they're pure traders. And every time I come on, they say, what do you talk about this value stuff? No, trading is about demand and supply. And I like that. It's honest. They say, I don't care about value. If NVIDIA is at 850, the mood is right. I'm going to buy it at 850 because it's going to go to 900. Doesn't matter what the intrinsic value is. And I completely understand that point of view because the pricing extremist says there is no such thing as intrinsic value. It's all an abstraction that you intellectuals come up with, or whatever they decide to call it. Intellectual is a kind word, but it might be idiots, whatever they want to call you. That price is set by demand and supply, and there will never be convergence. So as you think about markets, you can think about people falling into one bracket or the other. But if you truly are an intrinsic value believer, don't get too cocky, because there are two things that should keep you up at night. The first is you value the company, but you're not sure, right? You come up with the value, it could be wrong. So you're not sure what the gap is between value and price. You think there's a gap, but that's where you stop. You really don't know there's a gap. And second, even if you feel certain that there's a gap, that NVIDIA is overvalued, the second thing you're uncertain about is when will the price adjust to value? There's uncertainty on both dimensions. So let's talk about the gap. Let's assume you are an intrinsic value believer. You think there's a gap between value and price. For you to make money, the gap has to close, right? Saying, when will that happen? One view is what I call the karmic view, which is I don't control that. I'm going to buy, I'm going to go back to living the rest of my life. And over time, I have faith that the gap will close. Faith. Let's call it the karmic approach. The second is you try to find companies where you think things are in place for that gap to close, either because of something you do. You're an activist investor, you buy an undervalued company, you just don't sit there, you try to make the gap close. But the other is you might find things which you believe are catalysts. I'll give you an example. You have two companies that are undervalued. One company has a 43-year-old CEO and poor corporate governance. The other has a 79-year-old CEO. And forget about the corporate governance. I'll buy the company with the 79-year-old CEO. Sounds morbid, but catalysts require that markets look at your company again. You know, one time that markets look at companies is when the management changes. So you might say, look, not only am I going to look for undervalued companies, I'm looking for undervalued companies where there's something in place that'll cause the change. Maybe a shareholder in the midst, a CEO is going to move on, something that'll shake up the game. You know, as you watch the Disney Nelson Peltz battle, take a look at what Disney's stock price has done over the last few months. Nelson Peltz might not win that director's seat, but guess what? Not only has he made money, but everybody who invested in Disney then has made money, because to the extent that the price was less than value, he might have helped to close that gap. So any questions on the gap? So as you look at your company, not only should you be asking, now how undervalued or overvalued the company, but what can cause it? Now, one reason I keep revisiting companies on my blog and revaluing them is you value a company, it's not one and done. You've done the bulk of the work. It seems like a waste to throw that all away and start from scratch. So I revisit valuations, I value the company. In fact, Apple, Amazon, every one of the big tech companies I valued every year now for the last 15 years. And I've said this before, the fact that these companies have done really well might lead you to think, I would never have found these companies to be undervalued. That's actually not the case. Apple in particular swings between extremes. And the extremes are actually timed around the next iPhone upgrade. The next iPhone upgrade does much better than expected. Everybody thinks Apple's back to being a growth company, growing at 12% a year. The next iPhone upgrade doesn't do that well. This is the end for Apple. The world is going to finish them off. Right now, which of those two do you think investors are looking at Apple through? Pretty negative view on Apple right now, partly driven by the EU and the Justice Department coming after them, and partly by the fact that their revenues seem to have leveled off. So what I've done here is actually listed out my value per share over time and the actual price per share. I think it was Warren Buffett who described the market as this manic depressive that he trades it. So the market is manic, I sell shares back to the market. When it's depressed, I buy shares back. And you see that play out with a company like Apple. It's undervalued, it's overvalued. If you're a true investor, you should be buying when something is undervalued, selling when it's overvalued, which is my pushback against buy and forget about things, because That's often the advice you get from old-time value investing is you find a great company, just buy it, put in your portfolio. That might or might not work, but it is inconsistent with the whole idea of value investing. So I'm going to leave the intrinsic valuation part with a snap from one of my favorite movies. You guys seen The Wizard of Oz? Long, long movie, right? 3 hours and 7 minutes. Those days you got full value for your money when you went to the theater. None of these hour and 7 minute movies that you see now. So I'll compress the movie if you haven't seen it. This is how the movie begins. It begins with a tornado in Kansas. And that tornado sucks up this little girl called Dorothy. Don't ask me, I didn't write this. So you think this is very unrealistic. Tornadoes don't suck up people. That's how the movie starts. And it takes Dorothy and drops her on top of a witch. I forget now which was the Wicked Witch of the East, one of the wicked witches. And she kills the witch. And she's facing homicide charges. That's how the movie begins. So don't take a child to this movie. It's traumatic when it begins. So she's killed the witch. She's afraid to face homicide charges. So she wants to get back to Kansas. I'd have stayed in Oz, but for some reason she wanted to get back to Kansas. So she asked this munchkin by the side of the road, how do I get back to Kansas? He says, got to see the Wizard of Oz. So how do I find the Wizard of Oz? Follow the yellow brick road. And this entire movie, that's all you see, is Dorothy skipping. She never walks. If you don't believe me, watch the movie. She skips, she jumps, she walks down that yellow brick road. And along the way, she collects a motley crew, a cowardly lion, a scarecrow, a tin man, and they all want something. And they're all told, go see the Wizard of Oz. I'll save you the 3 hours in case you haven't seen the movie. The movie's climactic end comes about when about 10 minutes left in the movie, they end up in the wizard's chamber. So you can't see the wizard. He's behind a curtain. And each of them says, Dorothy says, I need to get back to Kansas. The lion says, I want courage. And the Wizard of Oz says, come back tomorrow. It's like a government office. They say, we can't come. We've been spending 3 hours of this movie coming all the way here. But just as they get ready to go out, the curtain falls and you see that there's no real wizard. There's a guy with, pulling strings in the back. What's this got to do with valuation? If you truly watch the movie to its end, it turns out that each of the characters got what they wanted somewhere on the journey. Dorothy ends up with these red shoes. When she clicks them together, she goes back to Kansas. The lion fights off some bad guys, gets courage. So basically, along the journey, they got what they wanted. Often, I think in valuation, we get so focused on the destination, that value per share. The real learning in valuation comes in the process of thinking through revenue growth and margins and reinvestment. And guess what? Your learning will come in the journey, not in the destination. So when you run into problems in valuation, go back to basics. Yeah. You can always email me, and I might try to give you the answer or look it up on Google search, but try to work through questions you run into. Because the answers you already know if you think about the basics of valuation. So I'm going to leave that as my last slide on intrinsic valuation and turn to packet 2. Let's talk about pricing. So we're now into packet 2. If you don't have it, don't worry, you can download it. Talk about pricing. The essence of pricing is you're trying to put a number on something based on what other people are paying for similar things. Let me repeat that again. You're putting a number on something based on what other people are paying for similar things. So if you think about the pricing process, there are 3 steps to it. First, you need to find similar things out there, comparable assets, peer group. Is that a subjective judgment or is it absolute? It's going to be pretty subjective, right? So if you're pricing a software company, saying, should I look at just big software companies? Should I look at just US software companies? There's an essence of subjective judgment. So you start with that. Second, you're going to very quickly discover, especially in the context of equities, you can't compare price per share across companies. Why is that? What's the most expensive company in the US if you just look at price per share? Berkshire Hathaway, I think, is what, 6 digits in its 200,000. And there's penny stocks which are worth pennies. So if I just said price per share is what I'm going to, so you can't compare price per share because price per share in a sense is arbitrary. I do a 2-for-1 stock split, your price per share drops by roughly 50%. Doesn't make it cheaper. So the second step, you take those market prices and you standardize them. Sounds fancy, but we're going to talk about the different ways you can scale prices. So you start with a peer group that you've chosen, you come up with these prices that are standardized, then you compare them across your peer group. And when you do that, you got to control for differences. Difference in what? Difference in growth, difference in risk, differences in cash flows. That is the core of pricing. And if you open up any equity research report, you'll see them come into play. A multiple, comparables, and a story. So I'm going to start by making an argument that much of what you see out there in banks, in portfolio management firms, that calls itself a valuation is really a pricing. Let me give you a few statistics to back that up. Now, about 25 years ago, I collected about 550 equity research reports from around the world, different sectors. I didn't read all of them, to be quite honest. I just collected them because I wanted to chronicle how equity research analysts put a buy or a sell. 85% of those reports were pricing, a multiple, comparables, and a story. There was a discounted cash flow page somewhere in there, but that wasn't used in any way to make the recommendation. 85% of equity research is pricing, because that's really your job. If you think about it as an equity research analyst, what am I asking you to do? These are the 20 companies you track. Which are the stocks that you'd buy? Which should you sell? You're never allowed to say, I'll sell everything, because you're not going to last as a sell-side equity research analyst. Your job is a pricing job. Not surprisingly, that shows up. So I said, maybe it's different in corporate finance, especially in M&A. After all, you're buying an entire company. Discounted cash flow valuation should be more frequent. And at first sight, it looks like they are. About half of all acquisitions have full-fledged DCFs. But then you take a closer look, you recognize very quickly that this is a masquerade. That the biggest number in these DCFs happens to be a terminal value. And we talked a little bit about this. That terminal value comes from using a multiple. It's a forward pricing. The world is a pricing world. And if you're an intrinsic value person, you're already an outsider. I'm not saying it's a bad thing. It is going to be something you have to accept. The world operates in pricing. And that's always, I've struggled with that, because I know at the end of this class, I'm going to do an exit interview that I've done with every one of these classes for the last 40 years. Because in the next few weeks, you're going to be pricing your company. You've done a DCF. So at the end of the class, I'm going to ask you, at the start of the class, I asked you, do you believe in intrinsic value? And that's say, I have no idea if you've never done it. Now that you've valued and priced a company, I say, which one would you hang your hat on? I'll tell you what the statistics look like historically in this class. When people leave this class, about 70% say they're now true believers in intrinsic valuation, partly because they want to keep me happier, right? They know my biases. About 20% actually prefer pricing. They said this was much easier. No growth, no margins, no sales to capital ratio. And about 10% become believers in efficient markets. Because you realize very quickly, I had contempt for markets. Now that I've seen how difficult it is to actually value NVIDIA, I have a new respect for markets. Perfectly healthy place to end up in. Because think of how much time you've saved over the rest of your life not having to value companies. You put in money in index funds and you go back to living your life. But 7 to 2, when people leave this class, they say they're believers in intrinsic valuation. I haven't done a follow-up survey, but I'd wager if I track people who've taken this class down 5 years or 10 years into their jobs and say, look, when you left my class, you told me you were true believers in intrinsic valuation 7 to 2. What do you do on your desk right now? How do you put a number? I'll wager the statistics get flipped. So the struggle I have with is what makes people go from being believers in intrinsic valuation when they leave this class to become pricing users 5 or 10 years into the job. And I've come up with 3 reasons, and you can add to those reasons. The first came to me while I was watching a Seinfeld episode. If you've never seen a Seinfeld episode, this will be completely foreign to you. But Seinfeld is the quintessential New York sitcom. The episode, one of Seinfeld's many girlfriends accuses him of being crazy. Says, Jerry, you're crazy. He says, look, if you think I'm crazy, you should see the guy who lives across the hall from me. You know who he was talking about, right? Guy called Kramer. If you've never seen Kramer, all you have to do is not even listen to him, but you see him and say, okay, that guy is crazy. You say, what's this got to do with pricing and valuation? It's much easier to sell a pricing than to sell an intrinsic valuation. And here's what. To sell me a company as cheap, what do you have to show? Something that's even more expensive, right? So you tell me Manhattan real estate is cheap. You say, what? This building is trading at what? $5,000 per square foot, but I can show you 3 other buildings that sell at $10,000 per square foot. Relative to Tokyo real estate, you're getting a bargain. Your cholesterol is 300. It's not too bad. Relative to people who've died of heart attacks in the last week, you look really good. All I have to do is pick the right comparables, and I can tell you that something is cheap, something is expensive. We forget how much of valuation is selling stuff. You're a portfolio manager trying to convince people to buy a stock, you're an equity research analyst. It's easier to sell a pricing than a discounted cash flow valuation. Second, it's easier to defend the pricing. Now, he showed me a DCF. I could poke at it. Right? Why is your revenue growth 8.3%? I think it could be 12%. Why are your margins so low? Everything is out there for people to look and say, I don't like that. In contrast, if you tell me NVIDIA is cheap because it's trading at 11 times revenues and all other big tech growth companies are trading at 15 times revenues, you give me a target that's tiny. You don't like 11, take it up with the market. In pricing, you're essentially saying it's not my fault. You might not like to pay $300 per user, but that's what everybody else is paying. It's easier to defend a pricing than a discounted cash flow valuation. So it's easier to sell, easier to defend. And there's a third thing going for pricing. I believe, as a believer in intrinsic valuation, that you're more likely to be right with intrinsic valuation than pricing. Let's say it's 55%. It's definitely not 100%. It's 55%, whereas the typical pricing, it might be 51%. 55 beats 51, right? But here's the catch. When you're wrong with intrinsic valuation, you're more likely to be wrong alone. Do you see why? The nature of intrinsic valuation is you're often buying something when everybody else is selling. You're buying PayPal, even though everybody hates it right now. You're selling NVIDIA, even though everybody loves it right now. So when you're wrong, you tend to be wrong alone. You know what happens to people who are wrong alone on Wall Street or any business? They tend to get fired. The nice thing about pricing is you always have lots of company. There are portfolio managers out there buying NVIDIA at $870, $880, $900 per share right now. Say NVIDIA goes to $450. Not a single one of them is going to lose their jobs. You know what their defense is going to be? Everybody was doing it. I know it sounds small, but it's a big deal. Survival in your job often means pricing is going to get a higher priority than intrinsic valuation. So it changed the way I teach this class. When I first started in the late 80s, I used to try to convince people that intrinsic valuation is better. You spend very little time on pricing. But I've learned over time that many of you, once you're done with this class and you get out there and you get jobs, your job is a pricing job. That we need to talk about doing pricing better rather than which one is the better way. So the market imperative here means that even if you're a true believer in intrinsic valuation, not an either or, it makes sense for you to actually price your company as well. So if you think your company is undervalued on a DCF basis, price the company as well. I mean, there's no cost to doing both. And if they both tell you the stock is undervalued and underpriced, you have two things going for you. Because ultimately, you don't care how you make money because the traders pushed up the price or valuers, who cares? So this should not be an either or. And if your job is built around you being compared to the rest of the market, portfolio managers, equity research analysts, it's no contest. Pricing is going to win out every single time. So to start this process off for pricing, I'm going to deconstruct a multiple. You see dozens and dozens of multiple out there. I'm going to give you a mechanism for looking at a multiple and saying, hey, why do we see all these different multiples? Every pricing multiple, if you look at it, the numerator has a market number. But that market number can just be a market value of equity, market cap, price per share. It can be market value of the firm, market value of equity plus debt, or more frequently, market value of equity plus debt minus cash, which is enterprise value. So all three are measures of what the market is attaching as a number to your company. That's the numerator. The denominator is your scalar. You can scale market value to revenues. Why would you do that? Because you're desperate, right? You're in a sector where everybody's losing money. What choice do you have but to scale it to revenues? So if you ask me what's the cheapest AI company right now, outside of NVIDIA, there isn't a single AI company that's making money. In fact, with AI companies, you probably can't even find revenues. So you know what you do then? You scale it to things that might create revenues, number of users, number of subscribers, number of software programs. Saying that's absurd. The nature of pricing is you have to find something positive to scale things to. You might even scale to the number of cars in the parking lot of the company. It sounds absurd, but you need a scalar. It could be to earnings. Those earnings can either be to equity investors, net income, earnings per share, or to all investors, operating income. It can be to cash flows, which in the case of equity can be net income plus depreciation, if you want to stop there, or free cash flow to equity. Or to the firm, where you take EBIT plus DA. EBITDA is just a rough measure of cash flows to the firm. Or you can do free cash flow to the firm if you don't like that shortcut. Or it can even be to book value. Why do you care? Because that's what the accountant tells you the company's worth. You're scaling to what the accountant's estimates are. That book value can either be book value of equity, it can be book value of equity plus book value of debt, or it can even be book value of equity plus book value of debt minus cash. If that sounds remotely familiar, that's the invested capital you see in. So your numerator is a market number, the denominator is a scalar. So what I'd like to do is set up a 4-step process for deconstructing multiples. And I'll make a promise, if you follow this 4-step process, you're going to be a much better pricer. And nothing in these steps requires finance. It's really more statistics and respecting the data. So the first step in the process is I'm going to take a look at your multiple. And I'm going to ask 2 questions. Is it consistently defined? Is it uniformly estimated? I'm going to kind of back in and explain what I mean by that. So when you say this is the multiple that I'm using, I'm going to pass it through that test. Those are definitional tests. Second step in the process, remember what pricing is all about. What do other people pay for similar companies? So if you're using a multiple, I'm going to give you the cross-sectional distribution of that multiple. Remember histograms in statistics? Very low-tech tool, right? So instead of just giving you the PE ratio of the market, I'm going to say this is how many companies the PE ratio is between 0 and 4, 4 to 8, 8 to 12. You're going to get perspective on what's high, what's low, what's typical. Define, describe. Third step, I'm going to use a discounted cash flow model to extract the variables that should drive the multiple you picked, whether it's PE ratios, EV to EBITDA. I said, these are the variables you need to be asking questions about. And only then am I going to apply the multiple. Define, describe, analyze, apply. My problem with pricing is not that people do it, but that they're incredibly sloppy and lazy about how they do it. They're in such a hurry to apply the multiple, they haven't gone through the first 3 steps. So let's go through this 4-step process and let's see how it helps us. So here's the first set of tests. You show me a multiple. I'm going to ask you, is this multiple consistently defined? Here's what I mean by consistency. If your numerator is an equity value, your denominator also has to be an equity value. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. I know it's cruel and unusual punishment to hit you this in the middle of the afternoon. But let me throw a few multiples at you, and you tell me whether they're consistently defined. Let's take the PE ratio. What's in the numerator? Equity value, firm value, enterprise value. It's equity value, price per share, market cap. What's in the denominator? Earnings per share, which is an equity value. Thank God for small blessings. The most widely used multiple in the world passes the test. PE ratios are okay. What about EV to EBITDA? What's in the numerator? Market value equity plus debt. It's supposed to be market value, but we cheat and use book debt minus cash. It's a rough measure of what the market is paying for the operating assets of the company, right? And EBITDA is a rough measure of operating cash flow. I don't like it that much. There's a lot of missing pieces, but EV to EBITDA is consistent.
Why is it usually used instead of, I don't know, operating cash flow?
We'll talk about that. There's no right multiple per se, right? It's whatever works in the sector. We'll talk about because it's not true that it's usually used. PE ratios are used in some sectors.
Oh, I
And
meant
EBITDA.
EV to EBITDA,
Yeah, as opposed to what?
operating cash flow.
When you say operating cash flow, what is your definition? It can't be the operating cash flow from the statement of cash flows, right? Why not?
Well, no, that's what I was.
Why
that's what I
not?
was referring to.
Why not? What's wrong with the operating cash flow in the statement of cash flows?
There's no.
What does it start with? You go to the statement of cash flows, the operating cash flow section. What is the line item that starts it off?
EBIT.
No, it's net income. Do you see the problem? Net income is a equity value. The cash flow you get is an operating cash flow to equity investors. If you divide market cap by that, we can argue whether it's a good multiple or not. You can't divide enterprise value by that.
Okay, why?
Let's talk about what happens when you have a mismatch. Let's say I took price to EBITDA multiples, right? And we'll talk about EV too. If I took price to EBITDA, and 8 of the 550 equity research reports actually use price to EBITDA, and one of them happened to be somebody who went through this class a few years earlier. So I called him. And he said, what's this about? And I said, I've been reading your equity research reports, very impressive. I noticed you use price to EBITDA multiples. He said, all the time. I said, you do realize they're inconsistent, right? He said, what do you mean? He said, the numerator is an equity value, your denominator is EBITDA. He said, I'm being consistent. I said, what do you mean you're being consistent? He said, I use price to EBITDA for all 15 companies in my sector. I asked him a question. I said, have you been noticing that companies with a lot of debt keep looking cheap to you? He said, yes. And I said, have you stopped and thought about why that might be happening? You see what's happening, numerator is market cap, right? Let's say I do borrow money and buy back shares. My market cap is going to shrink because I have less equity, but my EBITDA is still my EBITDA. It'll stay till the cows come home. So when I mismatch, what's going to happen is highly levered companies are going to look cheap on a price to EBITDA basis. In your case, if I take enterprise value and divide by operating cash flows, what happens to my net income as I borrow more money?
It reduces.
It goes down. My operating cash flow is going to go down. I'm going to get an EV to operating cash flow that looks high for highly levered companies.
Right.
Nothing to do with pricing. It's because I've mismatched the numerator to denominator.
Right, but I mean, a high EV to E, I mean, that ratio, you want it to be low.
That's exactly right.
If-
But in a
if-
sense, it can be low if you have no debt, and it can be high if you have debt. That doesn't help you, right? Because in a sense, you want to see what's truly cheap or expensive, not let financial leverage drive that choice. So if you're going to use operating cash flow from a statement of cash flows, the numerator has to be market cap and equity value, because then you're matching up your numerator to.
Operating cash flow to equity.
That's the only cash flow you get out of a statement of cash flows, right? It's net income plus change in working capital, plus depreciation plus change in working capital. It's a pure equity cash flow. Okay? So if you're going to use operating cash flow from a statement of cash flows, the numerator has to be a market cap. So I'm glad you asked that, because I see that happen all the time. People take EV and divide by operating cash flow from a statement of cash flows. I'll safely predict that highly levered companies are going to look expensive and lightly levered companies are going to look cheap because you've mismatched. Okay. Yes.
So in that scenario, the better multiple would have been EV to EBITDA.
Or EV to free cash flow of the firm, or EV to, if you want to redefine operating cash flow in terms of, you could start with EBIT times 1 minus T instead of net income, right? And then take the rest of the statement of cash flows, but it has to be matched up. Because if you don't match it up, leverage is going to come in
So it
and
has to
divide.
be some sort of
Pre-debt number, that's the key, right? Pre-debt number, right? Because once you let debt affect your numbers and you're not, EBITDA is pre-debt, of
Right,
course,
but
it's
EV
earnings
is
before
post-debt.
interest and taxes, right? Yeah.
EV is post-debt, right?
No, EV is with that, right? When you say post-debt, what do you mean? You
Like
add debt
with
on. It's with that. It's not post-debt.
EBITDA doesn't have debt. I mean. it's
EBITDA is
pre-debt.
pre-debt as well. So basically, it's to all, both debt and equity investors get their cash flows from EBITDA. So the numerator is equity and debt. The EBITDA is cash flows to both claim holders. I can't take EBITDA and compare it to net income, right? Because that's just to equity investors. So look at what's in the denominator. Look at what's in the numerator. The two have to match up, because if you don't,
Then why do people, focus on EBITDA when it's,
Why do people focus on revenues? Because revenues are always positive. What's the advantage of EBITDA versus net income? More companies have positive EBITDA than positive net income. So when you talk about losing companies with negative earnings, with P ratios, you can lose 2/3 of the companies in a sector. They all have negative earnings. EBITDA, you're less likely, especially with infrastructure companies. You can be losing money, but generate large positive cash flows. Your denominator has to be a positive number. There's no way around it. So sometimes the use of EBITDA is driven by the fact that you kept climbing the income statement till you hit a positive number. And EBITDA happened to be that stop. So is it consistently defined? So the next time you see an equity research report, open it up. In fact, go to Bloomberg, pull up your company because they report all the multiples. There are at least 3 multiples on that page that are inconsistently defined. I've told Bloomberg that they should remove it, but they're slow to act. But I'd like you to spot the multiples you see on a Bloomberg page that should not be there because they're incredibly misleading. Second question, is it uniformly estimated? Why does that have to be true? There are 20 companies and have PE ratios of over 20 companies. They have to be what does that mean?
So like you're considering it's GAAP or not GAAP.
Different accounting standards can live, the earnings per share, it gets even worse, right? Because different account. So basically I have to control for different, and even with the same accounting standards, aggressive companies, remember they're not breaking the rules, can report higher earnings than conservative companies. If you're not careful, you know what you're going to find. Aggressive companies are going to look cheap to you. Not because they're cheap, but because of the way they've estimated earnings. S&P for a brief period actually created the service where they took the reported earnings that companies had and then restated them using common accounting standard, so that you could make them more comparable. They found the demand was not there, they gave up on it, but something to think about, right? Because you're comparing across companies. Is it consistently defined? Is it uniformly estimated? So let's take a few multiples and play them through this test. I told you PE ratios are consistently defined. It's true. Numerator is an equity value. In fact, everybody kind of knows what the PE ratio is, right? Even Anna Kournikova seemed to know what the PE ratio is. Most of you don't remember Anna Kournikova, but she masqueraded as a tennis player for like a decade. Won absolutely nothing, but was on every commercial you could think of. So this was a Charles Schwab commercial from like 20 years ago. In the commercial, Anna Kournikova is playing somebody. Must have been an actress. She was actually winning. And in tennis, every 2 games, you switch sides. So the sun is not always in your eye. So switching sides in the middle of a tennis match. I don't know why this would come up, but Anna turns to the other actress and she says, PE ratio is price divided by earnings per share. I'd have beaten her up with the racket right there. No. But then she went on to talk about preferred dividends, and I kind of went over my head, but I turned off the TV and I said, does Anna Kournikova really know what the PE ratio is? Numerator is usually the current price, right? Unless you got a technical analyst gone crazy. They like to use moving averages for everything, to which my response is, have you ever tried to buy a stock at a moving average price? I've never been able to pull it off. Numerator is usually the current price or the current market cap. But in the denominator, here are your choices. You can divide by earnings per share in the most recent fiscal year, which is going to be called current PE. You can divide by earnings per share in the last 12 months, which is called trailing PE. You can divide by price by earnings per share in the next 4 quarters, which is called forward PE, or you can divide price per share by expected earnings per share in the year 2032, which is really, really forward PE. Saying, why would I do that? Again, desperation. You're the biotech analyst. Every company in your sector is losing money. The only tool you have is PE ratios. The only way you can get away with this, project the earnings per share for every company 10 years out. Divide the price today by expected earnings per share. You can divide by earnings per share before extraordinary items, after extraordinary items, by primary earnings per share, partially diluted, fully diluted. I remember about 10 years ago, I took Cisco, one of the most widely followed and traded stocks in the US. And I wrote out 35 different PE ratios for Cisco at one point in time, depending on the definition of earnings per share. I got a range from 14 to 35. You see, so what? Remember we talked about biases in the very first class? Let's say I want to convince you to buy Cisco, that it's cheap. Which of these multiples am I going to latch onto? The one that gives me a 14 or the one that's going to give me 35? 14. And if I want to convince you Cisco is expensive, if you ever see no, equity research analysts and CNBC are arguing about a stock being, take a look at how they measure their multiples, because it's going to give away their biases. Bullish analysts always like to use forward PEs. Why? Because forward earnings are higher than current earnings. You divide the price today, you get a lower number. Bearish analysts always like to use trailing earnings. So they'll be talking about the same company, giving you two different PE ratios depending on how they define. In fact, if I'd been making that commercial with Anna Kournikova, I'd have made the actress turn to it and say, forward earnings or trailing earnings, Anna, because then we would have discovered how much Anna Kournikova really knows about PE ratios. What I'm trying to say, though, is often people act as you talk about a PE ratio, we're talking about the same thing. At the risk of sounding incredibly stupid, ask the person, what's your definition of PE ratio? They're going to look at it and say, even Anna Kournikova knows what it is. No, I'm not as smart as Anna. Could you tell me your definition? Because I have no idea how you computed the PE ratio. So generally speaking, PE ratios are consistent, but you got to ask questions to make sure that you and I mean, if we're going to debate this, are we using the same measure of earnings? Yes. Yeah.
Growth rate basically in general, but if we're calculate the slides looking at the earnings, if they're gonna forecast earnings, like they can avoid.
But 1 year forward, right? So most analysts will do a 1 year forward. Growth that they don't want to do is deal with this long-term growth. So their defense will be, I can give you next year's earnings per share. But even in that, we know they're not that good, right? But you can see why they will go 1 year forward, and beyond that, they get a little shaky. No. But I think that's a false argument anyway, because you still have to think about growth to compare companies. So I don't think the argument really holds up, but that's their excuse for not doing intrinsic valuation in the first place. Let's stay on PE ratios. Let's suppose you take a sector where technology, where in addition to shares outstanding, these companies have different amounts of employee options they've granted over time. Okay? Some have very few, some have a lot, some in the money, some out of the money. Okay? You're trying to come up with a consistent measure of earnings per share. Okay? The price is the price. You can't do much about it. So I'm going to give you the choice, and you tell me with each one what the biases might be in terms of which companies will look cheap or expensive for all the wrong reasons. Let's say I divide by the actual share count outstanding. I divide price by the primary earnings per share with the actual share count. Which companies are going to look cheap to me? Companies with a lot of options or companies without options? If I divide price by primary earnings per share. Companies with a lot of options. Here's why. The market price for those companies is going to be lower because market knows there are a lot of options outstanding. You're taking that price, dividing by the earnings per share. You're going to see companies with a lot of options always look cheap to you if you divide by earnings per share. You think that's easy, let's fix it. Let's take all shares outstanding, that includes the options. It gets rid of the problem, right? Does it create a different bias though? Because what does it do then? Across, so let's say you have 5 companies, all with a lot of options, you brought them in. I'm treating all of those companies as equivalent, right? But some of these companies have in the money options, some have out of the money options. Already you can see that even if I bring in fully diluted, I'm going to create a different bias. I'm going to find that companies with a lot of valuable options look cheap to me as opposed to companies with cheap options. So price to primary doesn't work, price to fully diluted. Some use partially diluted. What is, you count only in the money options. Remove some of the bias out of, but you still have, you know what the right thing to do is, and nobody will ever do it? What did we do with options when we did discounted cash flow valuation? What's the right way to deal with it? We valued the options, right? You know what the right PE ratio for each of these companies should be? We should value the options as options, add that on to the market cap, because the market cap is just the common stock, and divide by net income. How often have I seen people do it? Never. Because the kind of people who use PE ratios are doing so because they don't want to do too much hard work. PE ratios can be messed up by options outstanding, and you got to factor that in somewhere. EV to EBITDA. When I first started in equity research in the 1980s, Maybe 1 in 100 reports used EV to EBITDA. It's very rare to actually see EV to EBITDA in equity research. Kind of taken off. We'll talk about lots of different reasons. But today, about a third of all equity research uses EV to EBITDA. Numerator is market value of equity plus market value of debt minus cash. Denominator is earnings before interest, taxes, and depreciation. So I'm going to ask you a question that I often ask equity research analysts who use EV to EBITDA almost on a daily basis. Why do we net cash out? Why do we use net debt in the numerator rather than gross debt? Why do we net cash out of the numerator? Yes, number 2.
You don't have the interest income, you have the denominator.
Because the interest income is not in the denominator. It's a consistency again. Let's suppose you have a company with 300 billion in cash. Right now, you're making 15 billion in interest income on that cash, right? It's not part of your EBITDA. It shows up below the EBITDA line item. The reason we net cash out is because the interest income from cash is not part of the denominator. And I've opened a Pandora's box here. Because what other things do companies own that's part of their market value, but the income is not part of EBITDA, in addition to cash? Go back to our discounted cash flow model. After cash, what was it we talked about? Cross holdings in other companies, right? Help me out here. If I own 5%, 10%, 15% of other companies, what happens? My market value reflects what I own. Market's not stupid, but my EBITDA doesn't reflect the EBITDA that I receive on those holdings.
Because that's investment income.
That's investment income. It shows up below the EBITDA. So you know what I need to do if I'm doing Tata Motors or Tata Steel or Tata Chemicals to compute the EV to EBITDA? Is in addition to netting out cash, I have to net out the value of those minority holdings. See, that's a pain in the neck. Hey, you thought you were running away from all those problems when you left discounted cash flow valuation behind, but they're chasing you down. So if you're minority interest, you need to net them out. What if you own 60% of another company? Tell me what happens to the EV to EBITDA multiple when you own 60% of another company. Go item by item. Let's start with the market value of equity. Where do you get that? You look at the market cap, right? Does the market know you own only 60%? Of course, it's not stupid. So your market value of equity includes 60% of the subsidiary. Where did you get the debt number to do this? You went to the balance sheet, which if you own 60% is fully consolidated. So I will count 100% the debt. Then I go to cash, which also comes on the balance sheet. I count 100% the cash. Then I get to EBITDA, which comes out the income statement, which is consolidated. You see the mismatch here? Equity value is kind of the odd man out because it counts only 60%. Everything else reflects 100%. So you know what equity research analysts who are careful try to do to the numerator to bring in the remaining 40%? Is there an item in the balance sheet that tries to capture the 40%? The minority interest, right? You'll often see minority interest added to the numerator because it's a very half-assed thing to do. Basically, you're bringing the 40% in and say everything's now 100%. There's another thing you can do. You can take out the effect of the cross-holding entirely, which in the case of equity means taking out the 60%, that's called a parent company EV to EBITDA. Remember I said, cross-holdings were a nightmare when we did discounted cash flow valuation? They're just as much a nightmare when you do multiples or pricing because they can affect the EV numbers. Yeah.
So we have market value of debt, but we are not.
Do we?
Huh?
Do we have market value of debt?
In the enterprise value.
No, but where do we get the market value of debt? Remember, these are numbers you pulled from somewhere, right? So tell me the process by which market value equity is easy, right? Share price times number of shares.
Right.
That's
Yeah,
your only
yes,
easy number.
market value of debt is.
You get it off the balance sheet. You can try to re-estimate, but it's coming off a balance sheet. It doesn't come out of the market.
Yeah, on the balance sheet is book value.
Yeah. And it's book value of 100% of the subsidiary, right? It's consolidated.
Wait, but my question is before getting to the crossholdings. We have debt in the numerator, but we're not counting the interest, the cost of that debt in the EBITDA.
No, wait, but the market value of debt you can't count the debt and the interest in the numerator because you can count one or the other. The present value of the interest is what you get as market value of debt.
Right.
Right.
But that's if you have market value of debt, but if you don't.
No, you can estimate a market value of debt, right? It won't be that different from the book value simply because if your interest rate is pretty close to market interest rate, your market value of debt and book value of debt will converge. And for many companies, that's going to be, that's why people take the shortcut of assuming book debt is equal to market debt. In theory, we should be trying to estimate the market value of debt by taking the present value of interest payments on the debt and the face value, discounting them all back at a current market interest rate. In practice, almost no one does that for EV. They
Right.
use book debt.
Right.
But even if you use
So
book
is that
debt,
an inconsistency?
well, you could argue that everything should be, but that's a lesser inconsistency than missing the 40%
40%.
from the subsidiary's debt, right? That you counted in as your total debt because you got that off the balance sheet. So even if you assume book value is equal to market value, you have a residual problem if you have cross holdings and you have a majority holding, because that debt doesn't capture the subsidiary.
Doesn't capture the subsidiary's benefit or.
Oh, I mean, your enterprise value reflects it, but I'm saying that every other number reflects 100% of the subsidiary, but you're only 60%. Right. Yes,
Are there not firms that basically assess the market value of debt?
you're not allowed to, assess the market value of debt? Yes, there are.
Like,
In the
what
footnotes,
company-
you'll often see that people,
Company's market value of debt.
yeah, but you'll see for most part, they do it, it'll be pretty close to the book value because again, they do it once a year at the start of the year using accounting interest rates. So there are firms that will give you a fair market value, nothing wrong with using them. But remember, you're doing this for 50 or 60 companies, right? So if you decide to do market value for some and book value for others, you run a different, there'll always be inconsistencies that pop up because this is not just one company anymore. You got to do this for the entire peer group.
But those firms would basically subtract out the 40% that's not relevant.
No, they don't.
They wouldn't do that.
No. All they do with market value of debt is mark to market what they see in the books. So I've never seen a company actually report just the subsidiary debt, the 60% broken out. The market value there is just taking the book value and restating it given what current market interest rates are.
The best thing to do in this scenario is basically subtract the 40% of debt that's attributable to the cross holding. And then in the denominator, basically.
You can do two things. One is you can add the 40% of equity to the numerator and make it all 100%. Or take the subsidiary, or subtract out 40% of the debt, the EBITDA, and the cash, because all of those you overcounted. No matter what you do, ultimately they've got to match up, right?
Adding 40% wouldn't be accurate because it basically.
None of the things you're suggesting would be accurate either, right? How are you going to subtract out the 40%? So in a sense, whatever pathway you adopt will have some estimation issues because they're all coming from accounting balance sheets, which are book value numbers. So I don't think there's an accurate answer. All you can have is a consistent answer. I'm going to close with, you had a question? Yep. Yeah. I'm going to close with the final comparison on this consistency issue. Now, there are these macro real estate people who constantly ask the question, is housing overpriced? One of the problems with real estate is because it's tunnel vision, you're comparing to other housing, you often don't realize how much you're overpaying for housing apartment buildings because you're comparing to other housing and other apartment buildings. So one of the suggestions that's been made on how to see if there's a housing bubble is to create something analogous to the stock market. So you can compare, what am I paying as a multiple of earnings in real estate as opposed to a multiple of earnings in the stock market? So here's one of the suggestions I've seen often. You take the price of a house and you divide it by the rental income you would make by renting that house out. You get a ratio, right? So if you pay $1 million for a house and that same house can be rented out for $50,000 a year, net of costs, $1 million divided by 50,000 gives you a multiple of 20 times earnings. What can you do? You can ask yourself, as an investor, would I rather invest in housing or rather invest in equities? But to make that comparison, you got to be comparing apples to apples. So let's say you take the housing price, you divide by the net rental income, you come up with a ratio. You're trying to figure out what ratio you can compare to the equity market. I'll give you the choices. Should you be comparing it to a price earnings ratio, an EV to sales ratio, an EV to EBITDA ratio, or an EV to EBIT ratio? What's in the numerator? You put the price of the house, right? That's EV or equity value? It's more to EV. So first you take the price earnings ratio. It's not an equity multiple, so it's an enterprise value. You divide by net rental income. Is that EBIT? Is that EBITDA? Is that sales?
EBIT.
It's probably closest to EBIT, right? Because it's not EBITDA. You haven't added back the depreciation you could receive on the house. You could do that if you wanted, but you did not.
Yeah, but then, and like whatever CapEx
That's what I meant by net. There's maintenance costs, et cetera. So
yeah.
basically, so basically subtracted out what you need to maintain the operating income. There are actually people who graph out this housing price to rental income. Right now, that ratio in many markets in the US is close to 35 or 40. So if you think stocks are expensive, then what the heck are you doing? Paying $3 million for a house in California, or $1.5 million for a house in Illinois, because at least you have to be internally consistent. Now, it's again something you can use to compare across markets, but you have to be consistent. So that's a definitional test. I'm going to stop there because when we start off next session, we're going to start with the descriptive test, which is really going to be testing you on your statistics and distributions, because that's basically what this will boil down to. So I will see you next session.
There's also like a market growing. So basically, that's why.
But eventually they would run out of food. We can't stay at that number forever. That's going to be the lever that we use.
The problem is if I change it now, the reason it might not be off, but the reason when people are going to complain is, look, I have a work visit that I've planned around the profit change. I put it out to the client, nobody would check. I never thought of changing it. Somebody objected to one person check, I put it up because I'm pre-committed on that date and people planned around that date. Next year, I will remember that because I know that's coming. No way. Many people taking both classes. But I put it out to see if nobody.
So one way also.
It's crazy because
So basically, the revenue, sorry, look at the evaluation, see if that's some provision, but I broke it out for revenues from the, basically what you have. So basically, just add on it from that, instead of having one revenue growth number, you'll have revenue growth in 53 markets. So this is an extension of the process, just make sure. You can have different growth rates, different margins.
All right, please.
Yeah. More line items.
Brian, you taught me today.
But then you'll have to read the process.
Yeah.
I know.
You're totally apart.
It's like, I wouldn't want to what? I don't know. Like one class. Essentially, like, stock price, stock market, their value doesn't know there's no valuation for the stock. Chance. So I was just, like, have a hard time.
Yeah,
So like, you have. We have. Capital. So we're like, the stock is their value. How do I understand? I will. You're a famous professor.